Hello and welcome to Big Deal. Now today on the show, we are picking one sector which has seen maximum private equity participation, and also this space has seen a fair bit of deals. In fact, the largest merger that we have seen this year has come from this particular sector and also promises to be active in the coming new year. We are talking about the housing finance sector, which has in the last few years created a bigger bucket of listed companies, especially in the affordable housing space. Let's welcome on the show Anandan, who's the founder of Aptus Value Housing, and Sumeet Nagar of Malabar Investments, which owns, remember, a minority stake in Aptus. Gentlemen, welcome to CNBC-TV18. Now, with both of you on the panel, we are aiming to get a full picture of the sector from the point of view of the investor as well as the company. So, Sumeet, starting with you, what about Malabar's investment strategy here, and how does Aptus investment fit into it?
Yeah, hi, good afternoon. Thanks for having me on the show. Malabar's strategy has been about finding niche industry sectors that have long-term secular growth trends that are favorable. And then number two, within that, to find outstanding companies or businesses which are run by terrific management teams that capitalize on that. And so in some ways, sort of Aptus, fits in that perfectly, right? So you have this affordable housing finance sector, which has seen very limited penetration and has a long runway for growth. And then within that, you have a company like Aptus, which has just been an outstanding performer in the southern Indian market, where they are the preeminent player in the affordable housing finance space. So it sort of epitomizes the strategy of finding, a market which is great long-term tailwind, and then finding a great player within that industry.
All right, so that's your investment thesis, and especially what you see in Aptus. So let me ask the company, Anandan, welcome to this discussion. Now, you've been serving and financing the affordable housing space for a few decades now. Now, penetration has been one of the key challenges, especially in the lower income group, that credit culture hasn't really picked up. Besides that, while we enter into a situation of we are seeing high inflation, interest rate hardening, and also job losses, how do you see this sector develop from here on?
Good afternoon. Thank you. The affordable housing finance sector, which caters to largely the informal segment of the customers coming from lower and middle income population, largely from Tier 3, Tier 4 cities, has been underserved, unserved for a variety of reasons. But the need for homes and the need for home loans are much higher in this segment. So in other words, there is there's a large market, significant market of home loan finance is there, typically in the quartile 2, quartile 3 population of India, comprising largely lower and middle income, and Tier 3, Tier 4 cities, largely informal. And this, gives an opportunity, two. One is really an ability to channelize institutional funding, like banks and other sources, from to the informal segments of the population, which helps in financial inclusion. Same time, ability to provide housing to the needy segments of the population. And that's where also it provides an excellent business opportunity for a continuous, consistent growth for many years to come. And if you do if your metrics are well, you can even aim for much more than the growth rate which is available in the formal housing finance sector. So in other words, given the low penetration and large pie, it provides a large opportunities going forward.
Right, the opportunity is there, but we have to see the penetration. How soon can that particular situation be corrected? Because if I remember, insurance took more than a decade to really come into the mindset and become a much bigger play in India. So what do you think about this, Sumeet? When we talk about the interest rate hardening scenario, as well as some of the consumption taking a hit because of prices going up, how do you view this sector in a changed environment?
See, first, just to complete this point on penetration, I think, Aptus, for example, has been growing at over 40% year on year over the last several years. And going, even now it's sort of growing more than 30% year on year. So that's the way that the penetration sort of gets sorted, is that you have a growth rate which is far faster than the economic growth rate, and that's how slowly you correct the low penetration issue. In terms of the interest rate hardening, the hardening interest rate only has limited impact on the housing finance business because it only impacts the new flow. It's only the new incremental borrowing that happens at the new interest rate. And if you manage your assets and liabilities sort of very well, it has some impact, but not too much, right? So that's number one. Number two is that you also have other levers in terms of your OPEX that you can manage and control. And then there is asset quality. So in this environment coming out of COVID, in most cases, for most housing finance companies or other financial companies, asset quality is improving, and as a result, the credit cost is coming off. So it has the ability to absorb some of that impact. But the most important is that the affordable housing companies have wide enough spread that they can absorb the minimal increase in the interest on the overall book much easier compared to markets where that margin may be thin or where the asset is more long duration. So we think that affordable housing finance companies like Aptus can actually absorb this increase in interest rate a lot better.
That's right. You talked about the growth in this particular space. And yes, it has huge, tremendous growth potential and has been growing at a faster pace. But Sumeet, as an investor, help us understand, the valuation dynamics. Fair bit of affordable housing companies have listed in the last few years. Aptus has been a recent one. But despite the growth trajectory for the company and the operational performance, the shareholder value return has been on the lower side. In fact, it has been lower than the IPO price.
So that has been the case, but it's only been a 1 year, right? And this is a marathon. It's a long journey. And I think what you do see is that the company has been through this period since the listing, has actually demonstrated stellar operating performance. I mean, they've grown their earnings quite substantially. They've grown all the operating parameters and improved them. So what happens is, you go through these phases of the market where the price may not appreciate much, but the operating performance continues to improve. And essentially what happens is that your multiple keeps getting compressing. And that's like a compressed spring. At some point, it ends up expanding. And so we've seen this happen in many cases in the past where companies do well, but the prices don't respond to that. But eventually they always do. And so that's what is happening in case of Aptus today. It's a short phase, and eventually the market performance has to be in line with the underlying operating earnings performance. That's what we've always seen. And that should happen here as well.
All right. But the stock market valuation is a function of many factors, and probably that scarcity premium in this particular space has also gone. So whether it's up for re-rating in terms of valuation needs to be seen. But Anandan, what do you think about this? And what is the growth strategy? We know your numbers from the last quarter, but what is your growth strategy going forward? What are the levers that you're going to really push for shareholder return? Because you have the listed stock where there are retail participants, but you also have Westbridge with a substantial stake of 37%. We have also got Malabar with 7.7% stake in the company.
No, the company has got clear, growth plans for a consistent, substantial growth for many years to come. And this growth, as far as the capital is concerned, this company is very well capitalized with high capital adequacy. And in terms of, it has got the, significant strength in terms of reach through the branch network. And more importantly, the company has built an excellent credit appraisal system for this category of customer, this profile customers. That's our strength, because this credit appraisal system is really acted as a very good stress test. In the last 10 years, and more so in the last 2-3 years on account of COVID, the all of us have gone through different impact on business, but Aptus has been able to do exceedingly well even during this stressed times, mainly because of its excellent credit underwriting and collection systems.
Right.
So that having established in terms of a good product delivery, and nearness to customer, better service in the form of branch network, and apart from that, we have one of the lowest operating costs, and our delinquency cost also is one of the lowest.
Yes.
In fact, a little while ago, you touched on the inflation and the interest rate. We're surprised that we have, despite significant increase in interest rates, which is affecting, the most part of the financial intermediaries, but Aptus, we have not yet revised our EMI so far.
Yes.
We are able to absorb whatever the increase in interest
Right.
rates within ourselves because of our very strong liability, franchise.
Right, Mr. Anandan, I take that point, and it's a very important point that that interest rate hike has not been transmitted and passed on to the consumers, but that is an industry-wide phenomena also. But there are many, many aspects to talk about, and wherever there is a private equity participation, there has to be an M&A or some deal potential going forward, as has been the case with the sector. We'll talk more about the deal dynamics when we come back after a very short break on Big Deal. Stay tuned. Welcome back. You're watching Big Deal, and we are talking about the housing finance space and the deal dynamics there. Anandan, we were discussing about your company's performance, trajectory, and the strong points that you have. One of the aspects that you mentioned is capital adequacy ratio. Now, I want to ask you, being a devil's advocate, that your company seems to have taken less leverage and over-equitized. What is the strategy on that particular front? Because it can be read in both ways, either a positive or even a negative, because you've deprived the company of growth capital, even though you had the headroom for leverage.
No, it is true that we have capitalized the company very strongly so that we are able to get a better credit rating and better funding support from diverse institutions, both long-term and at a lower cost. While initial threshold capital, our judgment of initial capital is what we have, and that will really take care of for the growth for many years to come. To say that in the next 5 years or more, we don't really need any more capital. Mainly because of as you said rightly, because of the existing leverage may be low, but we have started growing at about 25 to 30% CAGR a year to support that kind of growth. We are looking for the low leverage and also the good profitability, good financial metrics that we have, in the company today.
Yes.
So going forward, the capital will be better utilized, and even now our ROE, despite lower leverage, our ROE is one of the best. All the financial metrics, whether NIM, ROA, or even for that matter, ROE, we are closer to about 16%.
Sure.
And going forward, this will be even further improved substantially, reflecting the leverage, reflecting the growth of the company.
That's right. Well pointed out that the return on equity is still at industry standard levels. But Sumeet, the price to book multiples get affected in terms of valuations because of heavier equity. So what do you have to say about, pre-money to post-money flip and that affecting the valuations here?
Actually, if you really look, currently we have a net worth of about 3,200 crores. And in the IPO that we've done about a year and a half or so is only about 500 crores. The rest of the money is really not only from the shareholders, but almost equal amount has come from the company's internal accruals itself.
I get that. Yes. But my question was also to Sumeet as an investor. When you look at it from outside, how do you reflect on these dynamics?
So, I think, yes, the company has high level equity today. And you have to also remember that we've gone through 2 years of fair bit of turmoil in the industry. And having that equity sort of kept the company in very good stead, right? But I think going forward, as the environment is getting more benign, it's very clear that the company has the ability to grow for next many years. As Mr. Anandan put it, for the next 5 years, despite being able to grow at that 25-30% CAGR, the company doesn't need any equity infusion, and that puts it in a very rare sort of subset of financial companies who have the ability to grow at that rate without actually needing dilution. And so, as a result, what would keep happening is that the ROE each year would keep inching up, and usually the price to book ratio sort of reflects that. And so I think as the company keeps delivering that growth and sort of higher ROE, and by the way, because the company is in this good situation and also because it's profitable, it has the ability to keep paying dividends without having to worry about its equity book. So it sort of positions it very well. And yes, at this point in time, the leverage is very modest, and as a result, ROE is not as good as what this business is able to deliver. But that's okay. It's still pretty good, and I think it'll keep improving from here on every year.
More cautious approach during COVID time. I take that point, but my only bit is that I've heard this from many promoters that when the money is cheap, pick it, even if you don't need it, because debt is now getting more expensive. But Anandan, one more important aspect. You have investors in the company, and like several other housing finance, there are a whole host of companies with private equity participation, and they become very good potential targets for mergers and acquisitions and also giving exit to the investors. What are your thoughts and strategy on that, and especially on the succession planning, if you can throw more light? And could that be one of the big reasons for a potential merger and acquisition going forward as well?
See, our focus has been very, very clearly, we are focused on our operations in terms of improving our share of the market, maintaining a consistent and much higher than the industry growth rate. That's where this 25-30% CAGR comes in. And we are focused on our financial metrics. That remains one of the best in the entire affordable housing finance sector, with a NIM of over 11%, with an ROA of about over 8%, and even ROE started improving. So we got the best financial metrics. We got the highest productivity. We have got the lowest, credit cost, and we got a very strong balance sheet.
So succession and exit to the interview investors.
That's what the company will be focusing on.
Yes.
Now, if there are opportunities for mergers, if there are opportunities for, one will be open to look at it. But but other than that, we will continue to see. We are really operating in a segment which is growing substantially.
Yes.
So we don't have to really look for small pieces, because every year we will be adding about going forward. Substantial as our base balance sheet keeps going up.
Yes.
We will be adding substantial balance sheet ourselves. So we will be open, but we don't have anything specific to share at this point in time. As far as the succession plan is concerned, yes, my actual existing tenure, is another 2 years. But the board is well already started discussions, and we are hopeful of getting a person to succeed me
Right.
in the next much before at least 1.5 years before the actual retirement.
All right.
And having said that, the the entire team of Aptus, the top 10 management committee members of Aptus have been with the company last 10 years.
Right,
The
right.
also the attrition is 2-3 years. So the succession plan is there through the organization, other than me, that also we are attending to.
All right. In my small little experience of any company with this kind of a succession, where a requirement is there after the founder really steps down, that becomes a very big potential M&A candidate as well. And of course, investor exit is also something that would be required. But that was a discussion on the overall housing finance space from the investor as well as the company. Thank you so much, Sumeet, as well as Anandan, for joining us on this interesting discussion. With that, it's a wrap on Big Deal. Thanks so much for tuning in.